Hey, Brian Reed, I just read a comment from you. Let's see what that comment was. That's how I find investment properties. Let's see. Do you use creative financing in your deals, such as lease option, subject to, and wraps? What's your favorite? So, creative financing definitely helped me get started, and especially in the sense of sellers holding some of the original like purchase price. I think if you are starting in a position of low capital, I think if you are starting in a position where you might be self-employed, where you don't necessarily meet all of the bank qualifications, then creative financing is definitely something that will help you tremendously. I think for my answer, I want to separate creative financing from deals where the seller is involved and then deals where it's just creative financing. Like part of me wants to argue that the way that we finance every deal is in some way, shape, or form creative. And I've shared several times on this channel that what we do is we find private lenders. Oftentimes, these are friends, family members. These are loans that are made. There are first position mortgages. They're secured with the property in the first position. So they've got the first position mortgage. And we generally finance 100% of the purchase price and 100% of the rehab costs. And that is, again, secured with a promissory note and a mortgage from a private lender, someone that is not an institution. And since these private lenders are often friends, family members, things of that nature, then the requirements that banks normally have are not present. So there isn't a need for appraisals, really a need for inspections. There's not a need for, an underwriting of the deal. We're the ones doing the due diligence. We're the ones presenting the materials or presenting the, material on the deal. And what that does is it allows us to close very quickly. It allows us to finance 100% of the purchase price, 100% of the rehab costs, and we make sure that we stay lesser than 75% of the after repair value on that note. That way, whenever we package these together and we approach a traditional lender, one that is going to do long-term finance, then we have the ability to pull back all of the private lender money and pay off that entire first position mortgage in full. And then the only thing that is remaining as a mortgage on that property is that long-term debt. And that means that we have successfully converted 100% financing of that deal into long-term debt without utilizing any of our own money. I think that's extraordinarily creative. And that does not involve the seller. The seller doesn't have to approve that. The seller doesn't have to wait for their funds. At the time of closing, the seller is 100% funded. What they asked for that property, they got all of, minus the realtor fees if they used one, or any taxes that they still have to pay, things like that. So I would say that is probably the best way to be creative, and it's in a way that doesn't involve the seller. And I prefer this method of being creative because it doesn't involve the seller. And oftentimes, people that have properties aren't necessarily astute or educated investors or even familiar with the types of creative financing things that you're talking about. So generally, if seller financing or especially the subject to deals make any sense, then it's somebody found themselves in a bad position. They might have a mortgage on the property for more than the property is worth or something of that nature, where they're kind of in a bad spot and you're coming along and saying, hey, if the initial mortgage stays in place, I might be able to make this work from a cash flow perspective. That's a win for you. And I guess it's a win for the seller. And again, this is speaking on subject to mortgages, because that's going to release them of that burden that they aren't able to sell their property for what the mortgage is. So they don't have to come out of pocket to make up the difference if they sell. And it keeps them from a foreclosure. However, that is going to take a decent amount of education on your end. You're going to have to spend a decent amount of time with that individual and kind of explaining this to them. I also don't like it because in most subject to deals, the initial seller is the one that maintains all of the exposure. and the person that buys it subject to doesn't necessarily have any exposure from a legal perspective. And what I mean by that is on seller or subject to financing, the mortgage is going to stay in the name of the seller, which means in the event that you don't come through and you don't pay that mortgage as you've agreed to, that's not going to be a derogatory mark on your record. That's going to be a negative mark on theirs. And I don't like the way that feels. I don't like the way that looks on paper. And I don't think if another option is available, I don't think that should be kind of executed per se. I think generally, when you're talking about creative financing, especially subject to deals, you really want to be cognizant of the fact that it is a win-win. And a lot of the people that do a lot of subject twos, I'm just never confident that the seller side is much thought of, other than the fact that they might be avoiding a foreclosure. But it just doesn't feel right with me. It doesn't sit right with me. Not saying that you can't make money that way, just saying that is not a preferred method of kind of seller financing in my book. And as far as the seller financing of just the investor holding the mortgage, so we've done a lot of deals where investors have seller finances deals, either on land contract or just an outright sale, and then they hold a promissory note and the first position mortgage on that property. So, if at all possible, I would say, and if the seller is on board with it, I think that when you're talking about seller financing and you're given the option between land contract and seller financing, where they're the promissory note holder and the owner of that first position mortgage, I would say do a traditional sale and have the seller hold a promissory note and that first position mortgage. And I think that is a lot more clean cut. That will leave you with a lot less explaining to do to people that aren't familiar with the situations. Insurance companies get a little bit fuzzy with land contracts. Banks, when you go to refinance, get a little bit fuzzy with land contracts. We have found that a lot of utility companies don't like honoring land contracts. So for a while, when we were doing some land contracts, the utility companies wouldn't put the properties in our name until that land contract or the deed actually transferred. So they weren't interested in having someone else's name that wasn't the owner listed as the owner. So for those, we had to use the Other Investors LLC and just change the mailing address on those couple of properties and pay those that way. So it's going to be a lot more, I guess, crisp and clean cut if you are doing the promissory note and mortgage route part of seller financing. I think that's a fantastic way, and creative financing is really valuable and makes a lot of difference because it is, in fact, really malleable. Banks have very stiff rules, regulations, especially if these loans are being sold to Fannie Freddie on the back end. A thing that I now have to specify because those previous comments. But I'm just being funny. If two parties agree on particular terms, then you're able to do that. Banks are not that way. So when you're first getting started, rather than going through the extraordinarily stringent requirements, regulations, and expectations of banks, if you're able to circumvent those, albeit even temporarily, then seller financing can be a big win. The way that we used creative financing to really get our start with sellers involved is we purchased about 15 of our initial 21 properties using some sort of creative financing. And the pickle that or predicament that we found ourselves in at the beginning, where creative financing was both helpful and it kind of fit in our strategy as we were looking to grow pretty quickly. Because when we got started investing, I was 27, 28, and my brother was 29 or 30, somewhere in there. So our plan has always been accumulate as many properties and as many mortgages as we can as early on, because we would just barely be in our 60s whenever these properties and these loans fully matured if we got these 30-year loans, and way sooner if we got these 20-year. So I was self-employed when we started investing, and my brother just recently had a career change. So we were stuck in, from a bank traditional finance perspective, we were stuck in that 2-year period where we didn't have a track record. So even though we had income coming in, the banks were pretty particular about what they would look at, what they would count, and what they wouldn't. So we qualified for very few traditional mortgages at first because they didn't want to count the rental income, and they barely wanted to count any of our own kind of traditional income. So being able to buy 15 properties gave ourselves a massive leg up as far as the acquisitions and the cash flow perspective goes. And then once we actually crossed that 2 year threshold of our new jobs, of our ability to manage and run rental properties, then all of the income started counting. And then from there, we started being able to qualify for more mortgages and more traditional bank loans. But 100%, if you do not fit in this perfect cookie cutter box, then at first creative financing is something that's invaluable. However, I would like to pull all of this back together and say now that we are able to qualify for a lot of bank financing because we have the ability to utilize the private lender funds, then for the most part, I would say like 95% of the time, seller financing doesn't necessarily, that's not the best of all possible situations for both parties. It's not necessarily a win for everyone. If the seller has the ability to receive a lump sum, unless they have some particular tax issue that they're attempting to work through, then most people would prefer just getting a lump sum, cutting ties with that property, and not having any additional issues or contingencies on that property. A lot of times when people don't want properties anymore, they want to sell them, they want to be done with them pretty quickly, especially if it's a distressed property. So in most cases for us now, it makes most sense to get the seller disconnected from the property and sent on their way. The most recent times that we have done any sort of seller financing is one investor sold us a package of properties recently, and he is actually kind of breaking up his portfolio and wanting to diversify and has a certain amount of promissory notes or notes receivable that he wants to have coming in on a monthly basis. So that helps. That's a win-win because we get additional properties and he gets some of that notes receivable income on a monthly basis. And another was the recent time where we bought the property for 280,000, that package of 11. Those had a decent amount of exterior deferred maintenance on them, and they needed to be really just freshened up and kind of really tidied up in a little bit of a big way. A little bit of a big way. That's funny. So for there, they might not have qualified for bank financing at the onset because of the condition they were in. However, it was a very short seller financing term. It was an 18-month period. And in that 18-month, we were very intentional and strategic about cleaning up particular properties, getting the exterior in good shape so that when the appraisal went through them, there'd be very little issues. So now we're on the other side of that, and we're closer to the end of those 18 months, maybe right in the middle. And now we're looking to kind of exit those. So I think those two are pretty solid examples of when seller financing could be a win for both parties. But especially when you're first getting started, it might not be a bad idea to try to really lean into creative financing, get very familiar with it, ask every seller of a property that you're interested, whether or not they would be interested in something like that, because no's are free. And in the short term, especially if you are one that is not a cookie cutter recipient of traditional financing, then it would benefit you extraordinarily. Now, if you are a cookie cutter recipient of traditional financing, you have a solid W-2, then I would kind of skip that creative financing part and say, for the most part, if you can disconnect the seller from that property and any contingencies on that property moving forward, then that would probably be the better option rather than keeping the seller around, unless they really want passive income, they're trying to avoid a tax issue, there's an issue with the properties, or they just want to help you out. After that lengthy explanation. I would also like to circle back and say you should definitely be really careful to a lot of the people on the internet that I've seen kind of tout creative financing, seller financing, especially subject to financing. I would say just be really careful. Keep your ethical upright cap on pretty tight, and make sure that everything that you do could possibly be like a win for all parties involved. I would say that it is pretty easy to get a little bit predatory, especially if it is going from owner occupant to some type of creative financing. I would say I'm a little bit less stringent if it is investor to investor and you are getting seller financing from another investor. I would say make sure that you are always keeping the other person in mind and looking out for their best interests if you are negotiating some sort of creative finance with an owner occupant. That is also my biggest complaint on wholesalers is not necessarily being forthright or not necessarily having the best interests of the owner of that property in mind when you are crafting up your contracts. So be careful.
Thanks for watching that clip. I thought that was a good question. And I think you can ask good questions too. Join us every Friday morning at 8 a.m. Eastern Standard Time for a live stream Q&A where we answer plenty of questions just like this one. In the meantime, consider subscribing to the channel if you want more of this content. And if you want to increase your deal flow, analyze properties better, and help me feed my family, click the link below for a free 7-day trial of PropStream.